Joining me now is Mark Livingstone, Cornerstone First Financial. Mark, you've got inflation, you've got gas prices up, you've got now interest rates going up. What are we looking at here, Mark?
Well, good afternoon, John, and great to be here with you. Yeah, we've seen rates jump a full percentage point just since the beginning of March. And if we're going back to just New Year's Eve this year, 4 months ago, interest rates have jumped a full 1.5 points. That's the largest increase since May of 1994. And so what does this mean for your viewers is that rates have just moved to a level where they're losing money. If you take the average $350,000 mortgage across the country, that's an additional $350 per month to the pockets of your viewers and to all Americans because of these interest rate increases. So now the Fed has postured that they're going to raise interest rates again at the next meeting on May 4th. However, Chairman Powell just 2 weeks ago said he's going to take a more hawkish attitude and raise it by 50 basis points versus the 25 basis points that he raised it just a month ago. And so we're talking already that the market has baked in this 50 basis points increase. And so we're seeing these rates spike. Where just today, John, we've seen rates as high as 4.99% on a 30-year fixed. This is the highest interest rates have been in 4 years. This all in an attempt to get inflation under control on the heels of the news coming out today that inflation's at 8.5%. You see it in the grocery aisles, you see it in the gasoline pumps, and some economists are predicting, John, that it's only going to get worse with inflation hitting as high as 10% by the end of the summer.
Are we looking at a coming recession when we have inflation this high, now interest rates going up? And, you know, that's my first question. Are we looking at a coming recession here, Mark?
I don't think that there is a coming recession, John. I mean, it's all based on supply and demand, right? And right now there is such a demand for housing in the United States that the supply is just not there. And so we didn't build enough houses in the 2010s. We just, you know, it was because of the scare of the housing implosion that happened 2006 to 2009 that there wasn't enough housing being built. So now that we have 80 million millennials coming off the sidelines, what's happening is that there's not enough housing to go around. And so therefore, that's the supply and demand. But the losers in this whole situation of the interest rates going up are going to be the first-time home buyers. You know, they have interest rates going up, they have rents going up, they have inflation, they have home values going up. Last year, year over year, 19% increase in value of homes. And so the losers, unfortunately, are these first-time home buyers that were putting their foot in the water, deciding to come and maybe buy a home now. What are they going to do? So I don't see a recession, perhaps. But I do see that we are in for a big change coming if this inflation is not kept in check. And that is the quandary of the Fed right now. Do they keep raising these interest rates like they're supposed to get the inflation back to realistic numbers? Because if they raise them too quickly, we are going to be in for a recession.
Look, it's going to be a terrible situation. And like you say, first-time home buyers are losing. Because, you know, now the millennials are off the sidelines. They're ready to buy a house. They're ready to have a family, and there's nowhere to go. You just said $350,000 home. Your mortgage payment just went up $350 a month. I mean, you do the math.
$350 a month. That's right. And if
do the math. I mean, that's $4,000. That's almost $5,000 annually. That's a big number.
That's $110,000 over 30 years if they paid the loan for the life of the loan. And how about this?
Unbelievable.
Interest rates going to 6% by the end of the year. That's an increase of $575 per month versus what rates were at the end of last year. I mean, we're talking an additional $70,000 less that these home buyers can qualify for. What would you do with $70,000? You could put on a new garage, you could put on a new sunroom, but right now the viewers have $70,000 less buying power based on a $350,000 loan. That may not be a lot to some, but to us middle Americans, that's a ton of money, and that's what's happening right now with these interest rate increases.
But you've also got home values going up, Mark. I've only got just over a minute here, about a minute and a half. You got home values going up. So there is some good news. If you own a home now, you can refi. It's tax deductible. You can get some cash out in about a minute. How's that work?
Well, John, we've seen year over year increases across the country, 19 to 35% in home equity. So what that means to your viewers is that if they purchased a home and didn't put enough money down so they have PMI, or if they're looking to take cash out for any reason at all, whether it's paying off student loans or home improvement or consolidating credit cards, call us and you may be able to take that money out, tap into that home's equity, and use it to pay off some outstanding debt. And it may be tax deductible. And we do have loan officers standing by. You want to be working with an expert that can help your loan get to the table on time and know all your options, whether a refinance or a purchase. And you can check us out on cornerstonefirst.com, or we have loan officers standing by this afternoon, John, and that phone number is 888-417-2921, 888-417-2921, and we're licensed in 41 states. And again, it's about working with a team you can trust.
Listen, I've been saying this forever. I'm done doing business with anybody that doesn't share our values. Mark Livingstone does that. Give him a call today. But I tell you what, if you're trying to buy a house, you got a short window. I'm going to be right back with Bernie Kerrick.